In a move to hopefully get this sky-high inflation under control, the Federal Reserve officially raised interest rates by 0.75% today. This is the largest single increase we've seen since 1994. Federal Reserve Chair Jerome Powell says this won't be the last increase we see this year either. Powell has said it is possible more will be coming. The Fed, though, is confident with all these rate hikes in 2022, the Fed will get inflation back down to normal by 2023. I'm going to explain why that is in a second, and stay tuned for a Lisa demonstration. But first, I have reported on this page many times the biggest tool the Fed has to deal with inflation is interest rates. Interest rates determine the cost to borrow money for you, me, and businesses, whether that's your car loan, your credit card rate, your variable rate mortgage, or certain private loans. When interest rates are low, money is cheap to borrow, like it's been for several years. And that gives a lot of people and businesses the ability to spend and stimulate the economy. But all that spending can lead to too much money in circulation and an increase in inflation. And that's what we've been seeing. So imagine these hammers are interest rates and this box represents inflation. So the Fed likes to keep inflation at about 2%. Right now, inflation is at 8.6%, which is way too high. So these small hammers represent small interest rate hikes. And then we have the mallet to represent a major interest rate hike. So they don't drive us into a recession. The Fed has been using this 0.5% interest rate hammer, tapping on inflation, trying to get it down. But since they've used this hammer in March and May, it's done almost nothing to get this inflation under control. So today, they used this slightly bigger hammer, 0.75%, and they're tapping just a little bit harder on it to try and get it under control. They've got to use these small hammers first in the hopes of gradually getting inflation to come down. The Federal Reserve can't just take the mallet to inflation in one fell swoop, because that'll definitely send the economy into a recession. Now, lots of economists believe the Fed is too late in trying to address this inflation problem and say they should have started raising interest rates last year. Now, the Fed chair again today said he believes they can bring this inflation down without driving the economy into a recession. This is a first start. They use the term soft landing to describe what they're trying to do with this interest rate hikes and economy. Now, whether that's true or not, and it happens, we will all just have to wait and see. You also have to remember there are a lot of other factors that contribute to inflation that the Federal Reserve has absolutely no control over, including complications from the pandemic, the supply chain, global market gasoline prices, and food supply, all of which are in flux right now.